private placement and IPO method. The first step in commencing business of a company is to raise capital by the issue of shares. The shares of a company can be issued in three ways: by private placement, by right issue, public issue. Public issue of shares includes IPO method and offer sales.
Next we move on private placement method. A private company cannot issue a prospectus. Hence, it usually raises its capital by private placement. A public limited company can also raise its capital by placing the shares privately and without inviting the public for subscription of its shares. Private placement is the issue of securities of a company directed to one investor or a small group of investors. Generally, the investors are the financial institution or other existing companies or selected private persons such as friends and relatives of promoters. What is private placement? Private placement is a private alternative to issuing or selling a publicly offered security as a means for raising capital. In a private placement, both the offering and sale of debit or equity securities is made between a business or issuer and a select number of investors. Next, the company law defines a privately placed issue to be one seeking subscription from 50 members. In a private placement, no prospectus is issued. In this case, elaborate procedure required in the case of public issue is avoided. Therefore, the cost of issue is minimal. The process of raising funds is also very simple, but the number of shares that can be issued in a private placement is generally limited. The conditions of private placement. There are mainly two conditions of private placement. The first one is a company has to pass a special resolution. If the special resolution is not passed, the board of directors should make an application to the central government for obtaining the consent. The second condition, the shares should not be sold for a period of 3 years from the date of allotment. This period is called lock-in period. Private placement advantages and disadvantages. First, the advantages of private placement. Less expensive as various type of costs associated with the issue are borne by the issue houses and other intermediaries. And the placement of securities suits the requirement of small companies. Next one, the method is also resorted to when the stock market is done and the public response to the issue is doubtful. These are the main advantages of private placement method. Next, disadvantages of private placement. First one, concentrated of securities in a few hands, creating artificial scarcity for the securities, thus jacking up the prices temporarily and misleading general public. And the last one, depriving the common investors of opportunity to subscribe the issue, thus affecting their confidence level. Next one, the right issue. Right issue is cheap way of raising finance. It is an issue of shares to the existing shareholder in a proportion to their existing shareholding. In a right issue, no prospectus is issued. Next, public issue. Public issue means selling of shares or securities to public by issue of prospectus. Public issue is two types. The first one, offer for sale, and the second one, IPO, initial public offer. These are the two types of public issue. The first one, offer for sale. Under this method, instead of offering shares directly to the public by the company itself, it offers through the intermediary such as issue houses, merchant banks, investment bank, firms of stockbrokers.
Initial public offering IPO. An initial public offering is the first sale of a company's stock to the general public. In normal business circumstances, a company can either issue in debt or equity. So, if the company has never issued equity to the public and is doing it for the first time, it is known as an IPO. An IPO is generally initiated to get the new equity capital to the firm to raise capital for the future from public investors. There are two common types of IPO: fixed price offering and book building offering. The first one is fixed price offering. The company going public determines a fixed price at which its shares are offered to the investors. The investors know the shares price before the company goes public. Demand from the market is only known once the issue is closed. In this, the investor must pay the full share price when making the application. The second one is book building offering. Under book building offering, the company going to public offers a 20% price band on shares to investors. Investors then bid on the shares before the final price is settled once the bidding has closed. Investors must specify the number of shares they want to buy and how much they are willing to pay. Unlike a fixed price offering, there is no fixed price per share. The lowest share price is known as the floor price, while the highest price is known as the cap price.
Conclusion: both public issue and private placement are efficient methods of raising funds for a company. Thank you.